Hey everyone, it's Jeff Harrelson with Grizzly Loans. Today I want to go over different loan types that you might hear from your lender or your realtor, and you might have no clue what they're talking about. The first one is a conventional loan. Conventional loans are offered by private lenders, not backed by any government agency. Typically, they conform to Fannie Mae guidelines, including their loan limits. They typically require higher credit scores than other programs such as FHA, but they can go down lower, just usually the pricing gets a lot worse. Now, with conforming, you can put down as little as 3% down, but if you put less than 20%, there's usually private mortgage insurance or have a lender pay. Next type of loan I like to talk about is a jumbo. Jumbo loans are used to finance properties that are above the county limits for Freddie and Fannie. These loans are typically sold to the larger banks out there and other large investors. They usually require higher credit scores, require reserves, and are more stringent on the underwriting guidelines. These loans do not meet the standard criteria qualified mortgage as defined by the CFPB, Consumer Financial Protection Bureau. The big one that I'm seeing a lot right now is called a non-qualified mortgage or a non-QM loan. These loans are designed for borrowers that may not qualify for traditional loans due to factors such as self-employment, non-traditional assets, or high debt-to-income ratios. We typically see a lot of people use these loans for buying investment properties, and we call them DSCR, debt service coverage ratio, or bank statement loans is another large one for self-employed people where we can generate their income off their bank statements. Then you have pure hard money, which we're also seeing a lot of that right now. These are short-term loans given by private investors who specialize in these lending situations. Hard money loans are usually used for real estate investors or people with a business purpose that may not qualify for traditional mortgages. Interest rates on hard money loans are usually quite high and usually have several points to them. These are great products and for people that need to get a house bought fairly quickly, or it might not pass an appraisal. So this is why it's huge for people that are investing in homes, especially fix and flips that most investors might not want to buy because of the condition of the house. The fifth type of loan I want to talk about are government loans. These are loans backed by the government, such as the Federal Housing Administration, Department of Veteran Affairs, or the Department of Agriculture, USDA. FHA loans are popular for first-time homebuyers because you can put as little as 3.5% down. Also allows for a higher debt-to-income ratio and lower credit scores. There's also many first-time homebuyer programs associated with FHA that can make it so you can do 0% down. VA loans are one of the best loans out there, and a lot of people for some reason don't like them or are afraid of them, but they usually have some of the best terms out there and some of the easiest guidelines to get approved. USDA loans are designed for low to moderate income homebuyers in rural areas that offer 100% financing. If you're in big city or in Southern California in general, there's probably not too many properties that are eligible for USDA loans. However, there are small pockets throughout Southern California, but throughout the United States, there are many areas where this loan is available, and it also has typically very good terms for the borrowers. These are just a couple of type of loans out there, the general terms of them. Feel free to ask me more. Jeff Harrelson, Grizzly Loans.